Global stocks and bond yields fall sharply again overnight after the US imposes tariffs on Canada, Mexico and China, who retaliate with moves of their own. Australia's Q4 GDP is set to be supported by stronger exports, and New Zealand's housing market shows further signs of life. That's coming up in our 5 Things in 5 Minutes on Wednesday, March the 5th. And then, in today's bonus deep dive interview, ANZ senior China strategist Zhaopeng outlines what to expect from China's National People's Congress this week.
We expect China will set an aggressive budget plan for this year to offset the impact of tariff.
But first, in 5 and 5 with ANZ, global stocks fell sharply again overnight after the US confirmed 25% tariffs on imports from Canada and Mexico and an additional 10% tariff on Chinese goods. In response, Canada announced a range of tariffs, while the Chinese government announced a 15% tariff on US agricultural goods, including soybeans, dairy exports and fruit, which may benefit Australia and New Zealand, says ANZ economist Vicky Xiaozhou.
China has announced its retaliation measures promptly by putting up to 15% tariff on U.S. agricultural products, including soybean, fruit, dairy products, etc. This could potentially benefit markets which can provide similar goods like Australia and New Zealand. We maintain our base case that the additional 10% tariff on Chinese imports will result in a 0.5% decrease in China GDP growth over the next 4 years. The impact is still manageable.
As of 4 a.m. Sydney-Melbourne time, the S&P 500 and Dow were down around 1.5%, wiping out all of the gains from the Trump bump since January. The US dollar index was down another 0.5%, so that's more than 2% in a week, and the US 10-year yield fell as much as another 8 basis points to a new 2025 low of 4.10% overnight, on fears about slowing US growth. The Aussie dollar also fell 0.21% to 62.11 US cents, and the Kiwi was flat at 56.20 US cents. Number 2. In Australia, all eyes today are on December quarter GDP data, which will show how the economy ended 2024. ANZ Research is expecting a lift of 0.6% for the quarter. That's compared with a 0.3% lift in the third quarter. Senior economist Adelaide Timbrell says positive net exports yesterday mean there's more upside risk to the forecast than downside.
The partials data of trade and public demand were both above expectations. We also saw really strong dwelling investment growth in the quarter. This will be tempered by business investment, which we think will slow GDP growth in the quarter. And the production method of calculating GDP also points us to a 0.6% growth in the quarter. Stronger profits growth gives us a little upside risk as well, but the higher GDP deflator, so the amount of inflation in that data, will temper the impact on GDP.
Number 3. Now, to more current activity indicators in Australia, ANZ's Roy Morgan Australian Consumer Confidence Survey showed a dip of 2.1 points last week to 87.7. But as ANZ economist Sophia Angala points out, confidence is still up 2.6 points since the RBA's February cash rate cut.
We saw that all the sub-indices recorded a decline in the past week, but last week's GDP partials data, which showed weak private investment intentions and lower than expected non-residential construction work done, may have weakened that confidence regarding economic conditions. But overall, the sub-indices are still running higher than those averages that we saw in the second half of 2024.
Number 4. Meanwhile, Australian retail sales rose 0.3% in January, following a fall of 0.1% in December. Sophia says there has been strength in recent months in household goods spending.
The ABS did note in his release that January's rise was led by the food-related categories. So this includes food retailing, which covers supermarket spending, and those dining and takeaway categories, which both rose in January following falls in December. The ABS did note that sporting events held during the month of January supported that uptick.
Number 5. There's signs of further green shoots in New Zealand's housing market as building consents rose a seasonally adjusted 2.6% in January from December. ANZ senior economist Miles Workman says while an ongoing recovery is expected, the housing market isn't set to take off.
Our expectation is that the OCR is tracking towards a neutral level opposed to an outright stimulatory level, meaning that we're not expecting the residential investment sector to go back into overheated gangbusters territory anytime soon. But nonetheless, these data are certainly consistent with our view that things will start to pick up from here.
Miles Workman there. Now, in our bonus deep dive interview, ANZ senior China strategist Zhaopeng Xing explains what to expect from China's National People's Congress this week against a backdrop of tariffs, trade wars, and uncertainty. And what are the 3 things that we should watch out for?
This year, we pay attention to 3 particular things. The first one is the annual target, including GDP target, CPI target, and employment target. The second thing to watch is the fiscal budget, including the deficit number and also how much special treasury bonds to issue. The last thing to watch will be the press conference of the economic serum. Since China PM Li Qiang will no longer hold the press conference, the economic press conference will be the only communication channel during the NPC.
And what might we hear at this news conference?
I think at this moment, people pay attention to the U.S. tariff. Certainly, the China response will be the most important thing. And also, together, people will be interested in how China to retaliate and offset the impact of the U.S. tariff. Basically, we expect China will set aggressive budget plan for this year to offset the impact of tariff. We expect the deficit number will be 4% in percentage of GDP, and also there will be 3 trillion renminbi of special treasury bonds to issue. So China will likely to preserve this policy room for the rest of the year. Otherwise, I don't think China can have sufficient preparation for the tariff shock from the Trump administration.
Could you put into context the shock from the last tariff measures put in by the first version of Donald Trump?
On February the 4th, Trump announced the 10% additional tariff on China goods. Trump also announced another 10% tariff to imports from the 4th of March. So together, the effective tariff will be lifted by 20% by now. We expect this will not be the end, because in the rest of this year, Trump administration may impose additional tariff much higher than the current level. So the impact on China will be significant. We expect the current 20% additional tariff will cut China export to the US by 30%. This will be translated into about 0.2 to 0.3 percentage point of GDP loss for China. And at the same time, I think the renminbi exchange rate will also be pressured by the tariff. Basically, we expect 3% decline in renminbi effective exchange rate. That means China's share in global exports will also decline. Despite the US tariff, I think there will be no pressure for China on growth, because last year, especially in last Q4, China recorded a very significant rebound in the GDP number. Last Q4, it was 5.4. The growth momentum remain intact by now, because the PMI number released in January and February both strong. We expect the Q1 GDP number is still about 5%. For Q2 and Q3, I think there will be a low base effect, because last year in Q2 and Q4, China recorded the GDP figures were very low to 4.6 and 4.7%. So in the first half of this year and also in Q3, we don't see any growth pressure. Basically, we expect China GDP figures will continue to be above 5% despite of the US tariff. The real challenge, I think, in my view, will be in Q4. It's very likely to see China slow down again in Q4 this year. But overall, the whole year picture will looks like that 5% GDP will be an easy job for China this year. We expect that policymakers will place emphasis on CPI target or the urban employment target, not the GDP growth rate. The GDP growth rate will be much easier this year.
Zhaopeng Xing there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, March the 5th. Catch you tomorrow with analysis of what Australia's Q4 GDP data could mean for the RBA's rate-cutting cycle. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.